Crypto price consolidation will boost adoption. Bitcoin and other cryptocurrencies may be down from all-time highs, which were set earlier in 2021 in most cases, but this is not a bad thing for crypto adoption and development. Beginning in the second half of 2020 and accelerating through the first quarter of 2021, the cryptoasset space consistently hit all-time highs, set market capitalization records, and generally recaptured much of the excitement that had not been seen since the previous bull run in prices in 2017. Along with the increased interest and excitement, there were some signs that the market had overheated. In retrospect, the Beeple auction and Dogecoin surge may have signaling a market top. Furthermore, incumbent financial institutions, which are well known for their price and market forecasts, have recently issued more mixed and some conservative price estimates. Granted, these same institutions are 1, the polar opposite of Bitcoin's decentralized promise, and 2, have previously issued bullish price targets, but the point remains the same. The incredibly dramatic rise in prices for cryptoassets like Dogecoin also appears to be indicative of the frothiness that had engulfed the larger blockchain and cryptoasset marketplace. Obviously, assets are worth whatever the market determines they are worth, but the fact that a cryptoasset that began as a joke was briefly worth $50 billion does appear to support the case for some overheating in the space. Even as the market capitalization of many cryptocurrencies falls from all-time highs, there is reason to view such consolidation as good news for the space as a whole. Let's take a look at why crypto consolidating from all-time highs is actually a good thing for broader blockchain and crypto adoption. The hype has subsided. This is not to say that there isn't a lot of excitement and interest in the blockchain and crypto sectors, on the contrary, there is. This means that, while fully acknowledging the benefits of higher asset prices as well as the increased attention that higher asset prices bring to the table, more attention can be paid to practical and tangible blockchain and crypto applications. For example, Dogecoin's market capitalization may have reached $50 billion, but serious market participants would be hard-pressed to believe that such a valuation was indicative of future adoption. Tether, the USDT's issuer, received much less attention when it also reached a market capitalization of $50 billion, further solidifying its position as the largest stablecoin. Stablecoins, by all accounts, have more practical applications for individual and institutional adoption than Dogecoin. Products are available. The push for crypto productization has quickly progressed from wishful thinking to a real market reality, just not in the United States. This could change as the newly confirmed SEC chairman, Gary Gensler, is very familiar with the cryptoasset sector, as well as financial institutions' renewed interest. In addition to proposals for a Bitcoin exchange-traded fund, ETF, that have been submitted or are being worked on by some of the world's largest financial institutions, banking institutions are beginning to offer Bitcoin and crypto-related services to clients. Several major US banks have announced the launch of Bitcoin and crypto products for clients in 2021 alone. Some idealists may scoff at the entry of these established financial institutions into cryptocurrency, but the reality is that such actions will broaden the appeal of Bitcoin and related crypto products to a much larger non-expert market. Policy pertaining to cryptocurrency. What has been lacking in almost every major market is effective policy to encourage businesses and individuals to implement blockchain and crypto solutions. Some of this hesitancy, as previously stated, has been linked to the perceived, correctly or incorrectly, volatility and potential for investor losses in such a volatile market. Price declines, of course, count as price volatility and can certainly harm investors, but that is missing the point. The price discovery process, both upward and downward, is an essential component of any freely traded marketplace and the assets embedded within it. It is far too early to predict whether 2021 will be the year of price stabilization or a return to upward trends in the cryptoasset space, but reducing some of the potential overheating will be a positive step for policymakers seeking to productize blockchain and cryptocurrency. Simply put, less froth makes the entire sector more approachable and understandable for policymakers as well as new entrants. Price declines and lower trading levels aren't as exciting to discuss and participate in as price increases, but that doesn't make them any less important. Crypto consolidations are not a new phenomenon for crypto investors and market participants, but this is far from a crypto winter, especially when compared to the performance of any other investable asset over the last year. Having said that, reducing some of the potential overheating in the space is beneficial to the development of more widely accessible applications. Functionality, practicability, and understandability are essential characteristics of any successful application. Blockchain and cryptocurrency are no exception, and will benefit from reduced froth in the sector.